$11.5 trillion. That's how much money BlackRock manages. To put that in perspective, that is larger than the entire GDP of China. And right now, quietly, methodically, and with almost zero media coverage, BlackRock is moving that money into crypto. Not a little, not as an experiment. They are going all in. And by the end of this video, you'll understand exactly why and what it means for you. Welcome back. If you're new here, this channel covers blockchain technology and the future of money in plain English. Hit subscribe so you don't miss what's coming. Now, here's what's happening in the world right now. In April 2026, Bitcoin is no longer just a fringe internet currency. It is a regulated financial asset held by the largest institutions on the planet. BlackRock's iShares Bitcoin ETF, ticker IBIT, crossed $50 billion in assets under management, faster than any ETF in history. That record wasn't broken, it was obliterated. But the ETF is just the beginning. BlackRock has been quietly building something much bigger, a full crypto infrastructure stack, tokenized assets, blockchain settlement rails, digital custody solutions. In this video, we're going to cover 5 things: the history of how Wall Street went from mocking Bitcoin to adopting it, exactly how BlackRock's crypto strategy works, real-world evidence it's already reshaping markets, the very real risks and controversies nobody is talking about, and finally, what the next 3 to 5 years could look like. Stay until the end, because Section 4 contains information that most retail investors are completely unaware of, and it could matter a great deal. To understand where we are, you need to understand where we've been. In 2017, Jamie Dimon, CEO of JP Morgan, the most powerful banker in America, called Bitcoin a fraud. He said he'd fire any JP Morgan trader who touched it. The crowd laughed. Wall Street agreed. In that same year, BlackRock CEO Larry Fink called Bitcoin an index of money laundering. These weren't offhand comments. This was the institutional consensus. So, what changed? A few things happened simultaneously. First, inflation. After COVID-era money printing, institutional investors started genuinely worrying about the purchasing power of cash. Bitcoin's fixed supply of 21 million coins, hard coded and impossible to change, started to look less like a speculation and more like a hedge. Second, regulations started catching up. The SEC's approval of spot Bitcoin ETFs in January 2024 was a watershed moment. It wasn't just about one product, it was a signal. The US government would not ban Bitcoin. The legal fog had lifted. Third, and this is the part most people miss, the technology matured. Early Bitcoin transactions were slow, clunky, expensive. By 2024, Layer 2 solutions like the Lightning Network dramatically reduced fees and settlement times. Ethereum's smart contract infrastructure had become genuinely enterprise-grade. Most people don't realize this, but by the time BlackRock filed for its Bitcoin ETF in mid-2023, it had already been studying crypto infrastructure for over 2 years internally. This wasn't a pivot, it was a calculated, multi-year strategic repositioning. And BlackRock doesn't move first. It moves when it's sure it can dominate. Let's break down exactly what BlackRock is building. In plain terms, think of it as 3 layers. Layer 1 is the part you've probably heard of, the Bitcoin ETF. An ETF, exchange-traded fund, is basically a wrapper. Instead of buying Bitcoin directly and worrying about wallets and private keys, investors buy shares of IBIT on a stock exchange, just like they'd buy Apple stock. BlackRock holds the actual Bitcoin in custody. The investor gets the price exposure with none of the technical complexity. This sounds simple, but the implications are enormous. Pension funds, endowments, 401k plans, All of these have regulatory restrictions on what they can hold. An ETF clears those hurdles. BlackRock essentially built a highway connecting trillions of dollars in traditional capital to Bitcoin. Layer 2 is more advanced. Tokenized assets. This is where it gets really interesting. Tokenization means taking a real-world asset, say a government bond, a piece of real estate, or a money market fund, and representing ownership of it as a digital token on a blockchain. Instead of paper certificates or database entries at a clearinghouse, you have a cryptographic token that can be transferred in seconds, anywhere in the world, 24 hours a day. BlackRock launched its BUIDL fund, the BlackRock USD Institutional Digital Liquidity Fund, on the Ethereum blockchain in March 2024. It's a tokenized money market fund. By early 2026, it had grown to over $1.7 billion. That makes it the largest tokenized fund in the world. Stay with me because this next part changes everything. Layer 3 is the plumbing nobody talks about. Blockchain settlement rails. Currently, when you buy a stock, the actual settlement, the transfer of ownership and money, takes 2 business days. It's called T+2. That might seem like a minor inconvenience, but at institutional scale, it locks up hundreds of billions in capital every single day. BlackRock, working alongside its technology platform, Aladdin, is exploring how blockchain can collapse settlement to T+0, instant, real-time finality. The potential to free up that trapped capital is worth hundreds of billions of dollars annually in efficiency gains alone. Taken together, these 3 layers represent not just a new product line for BlackRock, they represent an attempt to re-architect the infrastructure of global finance itself. This isn't theoretical. Let's look at what has actually happened. Case Study 1. The IBIT phenomenon. When BlackRock's iShares Bitcoin ETF launched in January 2024, it set a record for fastest ETF to reach $1 billion in assets. It then broke its own record, reaching $10 billion. It reached $50 billion faster than any fund in ETF history, faster than gold ETFs, faster than S&P 500 trackers, faster than anything. The money didn't come from crypto enthusiasts. Analysis of 13F filings, the documents institutional investors file with the SEC revealing their holdings, showed hundreds of hedge funds, banks, and registered investment advisors buying IBIT. This was mainstream institutional capital flowing into Bitcoin through BlackRock's door. Case Study 2. The BUIDL tokenization race. BlackRock's BUIDL fund didn't just succeed on its own, it triggered a race. Within months of launch, Franklin Templeton, Fidelity, and JP Morgan all accelerated their own tokenized fund offerings. Industry analysts at Boston Consulting Group projected the market for tokenized assets could reach $16 trillion by 2030. But here's where it gets interesting. BlackRock isn't just a participant in this race. As the world's largest asset manager, its entry into tokenization essentially validated the entire sector. Institutional clients who were wait and see on blockchain suddenly had permission to engage. Aladdin is BlackRock's proprietary risk management and portfolio operating system. It manages risk analytics for assets worth somewhere between $21 and $25 trillion, used not just by BlackRock itself, but licensed to hundreds of other financial institutions, pension funds, and central banks. When BlackRock integrates blockchain capabilities into Aladdin, it doesn't just affect BlackRock's own portfolio, it potentially upgrades the infrastructure of the entire Aladdin client network. That's a Trojan horse, in the best possible way, for blockchain adoption at a scale that would have been unimaginable 5 years ago. Now, most videos on this topic are either pure cheerleading or pure fear-mongering. We're going to do neither, because the risks here are real, and you deserve to understand them. Risk 1. Centralization contradiction. Bitcoin was created as a decentralized currency. No single entity in control, resistant to censorship, open to anyone. When BlackRock holds billions in Bitcoin on behalf of millions of ETF investors, none of those investors actually own Bitcoin. They own a financial instrument that tracks Bitcoin's price. The voting rights, the custody, the decision-making, that all sits with BlackRock. Some crypto veterans argue this is a fundamental betrayal of Bitcoin's original vision. If BlackRock and a handful of other ETF issuers collectively hold 5 to 10% of all Bitcoin in existence, which is not far from current trends, that creates a concentration of power that Satoshi Nakamoto specifically designed the system to prevent. Risk 2. Regulatory reversal. The current crypto-friendly regulatory climate in the United States is not guaranteed to be permanent. Different political administrations take dramatically different views on crypto oversight. A future SEC could tighten rules on crypto ETFs, impose stricter disclosure requirements, or even unwind approvals in extreme scenarios. BlackRock is betting that regulatory tailwinds continue. If that bet is wrong, institutional crypto products could face existential legal challenges overnight. Risk 3. Technology risk in custody. Holding Bitcoin at BlackRock's scale requires flawless custody solutions. BlackRock uses Coinbase Custody as its custodian for IBIT. That introduces counterparty risk. If Coinbase were to suffer a catastrophic security breach, regulatory shutdown, or financial failure, it could create serious problems for IBIT holders. Most people don't realize this, but even the largest ETF in the world carries the operational risk of its underlying infrastructure. The keys to the Bitcoin kingdom sit with a single third-party custodian. Risk 4. Market concentration and volatility amplification. When institutions all pile into the same asset through the same vehicles, they tend to move in the same direction at the same time. Institutional herding can amplify both upward and downward moves. If a broad market shock triggers mass institutional redemptions from crypto ETFs, the resulting sell pressure could be far more violent than any previous Bitcoin correction. So where does this go from here? Let's talk about what industry analysts, technologists, and the institutions themselves are signaling. Prediction 1. Tokenization becomes the new normal. By 2030, tokenized versions of stocks, bonds, real estate, and commodities will likely be standard offerings at major brokerages. The question isn't whether tokenization happens, it's who controls the rails. Right now, BlackRock is building those rails. Prediction 2. Bitcoin becomes a macro asset. As sovereign wealth funds and central banks in smaller nations continue adding Bitcoin to reserves, following El Salvador's lead and accelerating trends in parts of Southeast Asia and the Middle East, Bitcoin's correlation with macroeconomic variables will increase. It will behave less like a speculative tech stock and more like digital gold. Prediction 3. The privacy tension peaks. As institutional blockchain infrastructure expands, so does on-chain surveillance capability. Every tokenized transaction is traceable. The tension between financial privacy and institutional transparency will become one of the defining regulatory battles of the late 2020s. Prediction 4. Ethereum's institutional moment. While Bitcoin dominates the store of value narrative, Ethereum's programmability makes it the natural home for tokenized assets and smart contract-based financial products. BlackRock's BUIDL fund runs on Ethereum. Expect a spot Ethereum ETF to see similar institutional inflows, and for Ethereum to become the infrastructure layer of institutional DeFi. But here's the biggest prediction of all, and it's one that almost nobody is saying out loud. BlackRock's endgame may not be to participate in the crypto market. It may be to become the custodian of a significant portion of the world's digitized wealth, the same role it currently plays in traditional finance, replicated on-chain. When $100 trillion in global assets eventually migrates to blockchain rails, and the trajectory strongly suggests this is when, not if. Whoever built the infrastructure, owns the custody relationships, and manages the compliance layer wins everything. Let's bring it home. BlackRock's move into crypto is not a trend. It is a structural shift in how global capital is allocated, stored, and moved. Here's what matters. The IBIT ETF broke every record in ETF history, proving institutional demand for Bitcoin is real and enormous. Tokenization of real-world assets on blockchain is already underway, with BlackRock leading the charge through its BUIDL fund. The Aladdin platform creates a multiplier effect. Blockchain capabilities embedded in Aladdin reach far beyond BlackRock itself. Real risks exist: centralization concerns, regulatory reversals, custody risk, and volatility amplification deserve serious attention. The long-term play is not about price, it's about infrastructure ownership in a world that is digitizing its entire financial system. My take? The irony of Bitcoin's story is that the technology built to disintermediate banks may end up being controlled by the largest bank-adjacent entity in human history. Whether that is a triumph of adoption or a corruption of purpose, that's a question worth sitting with. What I do know is this: the institutions are here, the capital is flowing, and the infrastructure is being built right now, whether the rest of the world is paying attention or not. If this video gave you a clearer picture of what's really happening in crypto and traditional finance, drop a like. It genuinely helps this channel reach more people who deserve to understand this stuff. And I want to hear from you. Do you think BlackRock's entry into crypto is ultimately good or bad for the average person? Drop your answer in the comments below. I read every single one. Subscribe if you haven't already. We cover blockchain, digital finance, and the future of money every week in plain English without the hype.